There's a building in the Cayman Islands, glass and steel, modest by the standards of international finance, sitting on a quiet street in Georgetown. Inside that building, there are registered addresses for more than 18,000 companies. 18,000 separate legal entities, each with its own incorporation documents, its own registered agent, its own nominal directors, its own bank account relationships. Most of these companies have never employed a single person. Most of them have never manufactured a product or provided a service in any conventional sense. Most of them exist for a single purpose, which is to hold money in a form that makes the money difficult to trace, difficult to tax, and difficult to seize. This structure, which is used today by corporations whose names you know, by investment funds that manage the retirement savings of ordinary people, by governments that want to move money without that movement being immediately visible, by wealthy individuals on every continent who have found that the distance between their assets and their legal liabilities is a distance worth paying to maintain. This structure did not exist before Meyer Lansky invented it. He did not call it offshore banking. He did not call it anything, because the people who build the most consequential systems rarely name them. They simply build them, refine them, make them work, and then watch as the world discovers that the system they built is so useful and so elegant that abandoning it becomes unthinkable. The system Meyer Lansky built in the 1940s and refined over the following 4 decades is now so deeply embedded in the architecture of global finance that the question of removing it is not seriously entertained by anyone. It is simply how money moves at scale. It is simply how the world works. The FBI spent 50 years trying to find Meyer Lansky's $300 million. They did not find it. Not because the money did not exist, because the system that contained it was designed to be unfindable. And the man who designed it understood from the beginning that the most powerful financial structure is not the one that generates the most money. It is the one that makes the money it generates permanently invisible. This is the story of that system, of how it was built, brick by brick, through 4 decades of necessity and intelligence, of what it means for the world that the architecture of modern offshore finance was invented by a man the FBI classified as a criminal, and of the specific irony that the Fortune 500 companies, whose tax structures rely on variations of Meyer Lansky's innovations, have never, in any annual report or shareholder communication, acknowledged the debt they owe to the man who built the foundation they are standing on. To understand what Meyer Lansky built, you have to understand what the problem was that he was trying to solve. And to understand the problem, you have to go back to the beginning of serious organized criminal enterprise in America, which is to say, you have to go back to Prohibition. When Prohibition begins in 1920, it hands organized crime an extraordinary opportunity. The opportunity is not primarily criminal in the conventional sense. It is fundamentally a logistics and finance problem. The demand for alcohol does not disappear because the law has made alcohol illegal. Demand does not respond to legislation. What Prohibition does is create a situation where the only suppliers of a product that millions of people want are people who are willing to operate outside the law. And those people, if they are organized and competent, can make extraordinary amounts of money. The problem is, what happens to that money once you have it? Cash is physical. Cash occupies space. A successful bootlegging operation generates cash at a rate that creates immediate practical problems. Where do you put it? How do you move it without attracting attention? How do you spend it without generating questions about where it came from? The federal government caught Al Capone not by proving he ran a bootlegging operation, though everyone knew he did. They caught him by proving that he was spending money he could not explain, that his visible lifestyle was incompatible with any legitimate income he could document. Tax evasion. The money itself, improperly handled, became the evidence that destroyed him. Meyer Lansky watches what happens to Al Capone and learns the essential lesson. The lesson is not that you should make less money. The lesson is that you should make the money invisible. That the gap between what you earn and what you can explain must be closed not by earning less, but by building a system that makes everything you earn explainable. He is, at this point in the early 1930s, a young man in his late 20s who has been building criminal operations with his partner Bugsy Siegel since their teenage years. He is not yet the most financially sophisticated person in the organized crime world, but he is already the most financially curious. He reads, he studies. He is particularly interested in how legitimate financial institutions work, and how banks move money, and how corporate structures create legal distance between assets and liabilities. He is teaching himself the architecture of legitimate finance, not because he intends to operate legitimately, but because he understands, with a clarity that almost nobody else in his world possesses, that the tools of legitimate finance are the most powerful tools available for making illegitimate money safe. The first mechanism he develops is the simplest and the oldest: cash businesses. A cash business is a business that takes in cash from customers in the ordinary course of its operations, which means that cash can be added to the legitimate revenue without attracting specific attention. Laundromats, restaurants, parking lots, vending machine operations, any business where cash transactions are normal and expected, and where the volume of cash on any given day is difficult to verify independently. You put illegal cash into the register. It comes out as legitimate business revenue. You pay taxes on it. Now it is clean. This mechanism is not Meyer Lansky's invention. People have been using cash businesses to clean money since money existed. But Meyer Lansky understands its limitations immediately. The limitation is scale. You can run a laundromat through a laundromat. You cannot run $300 million through a laundromat. The scale of what he is building requires something more sophisticated, something that can handle volume without creating the kind of anomalous patterns that attract attention. A laundromat that takes in 10 times more cash than every other laundromat in its neighborhood is a laundromat that gets audited. So he builds the next layer: casinos. Casinos are almost perfectly designed for the purpose Meyer has in mind. They are businesses that take in cash at extremely high volume. The volume is variable and difficult to verify from outside because the amount of money bet on any given night is not publicly disclosed and not independently observable. Cash goes into a casino as bets. Cash comes out as winnings. The casino takes a cut, which is its legitimate revenue. And cash that enters the system as illegal proceeds can exit the system as casino winnings with a completely legitimate paper trail attached. Meyer Lansky does not invent casino money laundering either, but he industrializes it. He takes a technique that existed in crude form and he builds it into a systematic operation with professional management, consistent execution, and the kind of financial discipline that allows it to scale to the level his operations require. By the early 1940s, his casino operations, running in several states and territories where gambling is either legal or tolerated, are processing substantial volumes of cash and producing clean money at a rate that his legitimate business operations alone could not approach. But he is still not satisfied, because even the casino layer has limits. There is a ceiling to how much money you can clean through domestic operations without the patterns becoming visible. The IRS is not stupid. Federal investigators are not stupid. If you are running casinos that are generating revenue wildly inconsistent with their size and location, somebody is eventually going to ask questions. The domestic layer works up to a point. Beyond that point, you need something the domestic layer cannot provide. You need distance. Geographical distance between the money and the jurisdiction that wants to tax it and seize it. This is where Meyer Lansky's most consequential innovation begins. the offshore layer. The concept of using foreign jurisdictions to shelter assets is not new in the 1940s. Swiss banking secrecy has existed since the 18th century. Wealthy individuals have been depositing money in Switzerland for as long as Switzerland has been willing to accept it, which has been a very long time. Because accepting other people's money and keeping quiet about it has been good business for Swiss banks across every political and economic condition that Europe has experienced since the Napoleonic Wars. The Swiss banking tradition of absolute discretion, enshrined in law since 1934, is well established by the time Meyer Lansky starts thinking seriously about offshore architecture. What is new is what Meyer Lansky does with it. What he does is not simply deposit money in Switzerland and leave it there. What he builds is a system for moving money through multiple jurisdictions in a sequence that progressively destroys the trail connecting it to its origin. Money does not go directly from a Las Vegas casino to a Swiss bank. It goes from the casino to a front company in one jurisdiction, from that company to a related company in another jurisdiction, through a transaction that appears to be a legitimate business arrangement, from that company to a nominee account in a third jurisdiction, and from that account to the Swiss bank through what appears to be a normal international business transfer. At each step, the connection between the money and its origin becomes more attenuated. By the time it arrives in Switzerland, it looks, to any investigator trying to trace it backward through the chain, like ordinary international business revenue. This layering concept, which Meyer Lansky develops and refines through the 1940s and 1950s, is the foundational architecture of what we now call money laundering. The term itself, the metaphor of washing dirty money clean, is not coined until the 1970s, but the concept, as Meyer Lansky practices it, is fully formed by the late 1940s. Placement. The introduction of illegal cash into the financial system. Layering. The movement of that money through a series of transactions that obscure its origin. Integration. The reintroduction of the cleaned money into the legitimate economy as apparently legitimate funds. These three stages, which form the basis of every anti-money laundering regulation and every financial crimes textbook in the world today, are the stages that Meyer Lansky's system executes. He did not name them. He built them. The Caribbean becomes critical to the next phase of development. The Bahamas, in particular, offers something that the United States and Western European jurisdictions cannot. Political stability combined with legal infrastructure that is specifically designed to attract foreign capital by providing confidentiality and favorable tax treatment. Meyer Lansky establishes relationships with Bahamian banking institutions in the late 1940s and 1950s that serve as crucial nodes in the network he is building. The Bahamas is close enough to Florida to be operationally convenient. It is a British territory with functioning legal institutions that provide the kind of stability that makes banking relationships durable. And it is outside American jurisdiction in ways that matter enormously when American investigators start asking questions. The nominee director structure is one of Meyer Lansky's most elegant inventions. The problem with owning a foreign company is that ownership creates a legal trail. If Meyer Lansky is the registered owner of a Bahamian company, that company is traceable to him, and the assets it holds are potentially reachable by American authorities through legal assistance treaties and other mechanisms of international legal cooperation. The solution is to not be the owner. Instead, you find individuals who are willing to serve as nominal directors and shareholders of the company for a fee, typically lawyers or accountants in the relevant jurisdiction, who provide this service professionally and discreetly. On paper, the company belongs to these nominees. In reality, under a separate private agreement that is not filed anywhere, the beneficial owner is the person who actually controls the assets. The nominee structure creates a layer of legal fiction between the beneficial owner and the assets that is extremely difficult to penetrate without the cooperation of the nominee, which cooperation can be structured to be legally unavailable. This structure is used today by virtually every major law firm in every offshore financial center on Earth. The nominee director is a standard service offered by incorporation agents in the Cayman Islands, the British Virgin Islands, Panama, Luxembourg, Ireland, Singapore, and dozens of other jurisdictions that have built financial services industries around the provision of exactly the kind of legal distance that Meyer Lansky required in the 1940s. The specific mechanism varies by jurisdiction and has been refined over 8 decades of legal development. But the underlying concept, the separation of legal ownership from beneficial ownership through the use of nominee structures, is Meyer Lansky's concept. He did not patent it. It is now simply part of how the world works. The loan-back mechanism is another Lansky innovation that has become standard practice. The problem with having $300 million in offshore accounts is that the money is offshore. You cannot spend it in America without bringing it back, and bringing it back raises the question of where it came from. The solution Meyer Lansky develops is the loan. The offshore company, controlled through nominees, loans money to a domestic entity controlled by Meyer Lansky or his associates. The loan is documented with proper paperwork, with interest terms and repayment schedules that make it look like a normal commercial transaction. The domestic entity receives the loan proceeds and can use them for legitimate domestic investment. The loan is never actually repaid, or is repaid through a subsequent transfer that cycles the money back through the offshore layer. But on paper, it appears as a normal business liability. The money has effectively been moved from offshore to domestic without triggering the questions that an unexplained transfer of funds would generate. This mechanism, the loan back, is today used by multinational corporations to move money between their international entities in ways that minimize tax liability across jurisdictions. It is used by private equity funds to extract value from portfolio companies through what are called management fees and intercompany loans. It is used by technology companies to hold intellectual property in low-tax jurisdictions and license it back to operating entities in high-tax jurisdictions, effectively transferring profit from where it is earned to where it is sheltered. The specific legal instruments are more sophisticated than what Meyer Lansky used in the 1950s. The underlying concept is identical. The real estate layer is the final major component of the architecture. Real estate is uniquely useful for moving and sheltering money because real estate transactions are large, relatively opaque, and accepted as normal uses of capital in every legal and financial context. Meyer Lansky begins purchasing real estate through corporate entities in the late 1940s, using capital that has passed through the casino and offshore layers to fund purchases of hotels, apartment buildings, commercial properties, and land. The real estate generates legitimate rental income. It appreciates in value. It can be refinanced, with the loan proceeds providing additional clean capital. And when it is eventually sold, the proceeds appear as legitimate capital gains from a documented investment, entirely unconnected to the original illegal revenue that funded the purchase. Real estate has remained the dominant mechanism for moving large amounts of money through the legitimate financial system since Meyer Lansky identified it as the ideal terminal investment layer. The luxury real estate markets of New York, London, Miami, and other major cities have been documented extensively in the past 2 decades as repositories of money that has traveled through offshore and other laundering mechanisms before being invested in property. The specific countries of origin of the money and the specific mechanisms used to clean it before investment have changed and evolved. The basic structure, illegal revenue to offshore layer to real estate, is the structure Meyer Lansky built. By the mid-1950s, the complete system is operational at scale. Illegal revenue enters the system through casino operations. It moves through a domestic cleaning layer using cash businesses and inflated casino revenues. It then moves offshore through a series of layered transactions involving front companies, nominee structures, and correspondent banking relationships. In the offshore layer, it accumulates in accounts that are legally inaccessible to American authorities. From the offshore layer, it re-enters the American economy through loan-backed mechanisms and real estate investments. The money that arrives at the terminal end of this journey is clean. It has documentation. It has a paper trail that, while complex, tells a story that is internally consistent and legally defensible. It can be spent, invested, inherited, and donated without triggering the kind of scrutiny that would expose its origins. The FBI knows this system exists. They have known since at least the early 1950s that Meyer Lansky is operating some kind of offshore financial architecture. What they do not know, what they spend 50 years failing to determine, is the specific details. Which banks? Which jurisdictions? Which nominee names? Which corporate structures? The architecture is visible from a distance, the way you can see that a building exists from across a city without being able to see the specific arrangement of its interior walls. They can see Meyer Lansky's financial system from a distance. They cannot see inside it. This is not an accident. Meyer Lansky has designed the system specifically to defeat the investigative capabilities of the federal government. He understands those capabilities better than most investigators understand them themselves, because he has spent 30 years studying how financial investigations work, where their legal authorities begin and end, what information they can compel and from whom, and how to structure transactions so that every piece of evidence an investigator can legally obtain tells a story that is consistent with legitimate activity. He is not just building a financial system. He is building a financial system that is specifically optimized to survive investigation by the most powerful law enforcement apparatus in the world. The Swiss banking secrecy laws, which make it illegal for Swiss banks to disclose customer information to foreign authorities, are the cornerstone of the offshore layer's legal protection. Meyer Lansky's money, once it is in Swiss accounts, is legally protected from American investigators by Swiss law. The Americans can ask. The Swiss bank will decline to answer. No Swiss criminal law has been violated by the deposit of foreign funds, regardless of the origin of those funds, and therefore there is no legal basis for the Swiss bank to cooperate with a foreign investigation. This legal structure, which frustrates American investigators throughout the 1950s and 1960s, is a feature that Meyer Lansky deliberately selects for. He does not use Swiss banks by accident. He uses them because he has studied the legal framework and concluded that they provide precisely the protection he requires. The Bahamas, Panama, and other offshore jurisdictions offer variations on this protection, each with its own specific legal architecture and its own specific advantages for particular types of transactions. Meyer Lansky does not use a single offshore jurisdiction. He uses multiple jurisdictions, routing money through different layers in different countries, depending on the specific requirements of each transaction. This multi-jurisdictional approach means that even if investigators succeed in penetrating one layer of the system, the information they obtain points to entities in another jurisdiction, where a separate and equally impenetrable legal framework applies. The system is not just deep. It is geographically distributed in a way that makes comprehensive penetration extraordinarily difficult, even for an investigator with unlimited resources and unlimited legal authority, neither of which the FBI actually has. What Meyer Lansky builds in the 1940s and 1950s is refined and extended in the 1960s and 1970s as the international financial system becomes more sophisticated and as new jurisdictions enter the offshore market with their own legal frameworks designed to attract foreign capital. The Cayman Islands adopt their banking secrecy legislation in 1966. The British Virgin Islands developed their offshore company infrastructure through the 1970s. Luxembourg expands its financial services sector. Singapore positions itself as an Asian offshore center. Each new jurisdiction adds new options to the menu of available structures, and the system that Meyer Lansky pioneered expands to incorporate them. By the time Meyer Lansky dies in 1983, the offshore financial system he helped create has grown so large and so deeply integrated into the global economy that it is essentially impossible to remove. The estimates of total assets held in offshore jurisdictions vary depending on methodology and definition, but the most credible academic estimates suggest that somewhere between $20 and $30 trillion is held in offshore structures globally. $20 to $30 trillion. The GDP of the United States is approximately $25 trillion. The amount of money sheltered in offshore structures that trace their conceptual lineage to the innovations of Meyer Lansky and the handful of other financial architects of the mid-20th century is roughly equivalent to the entire annual output of the world's largest economy. The corporations that use these structures are not criminal enterprises in any legal sense. They are, in many cases, among the most respected companies in the world. Technology companies that hold their intellectual property in Ireland and license it to operating subsidiaries in higher tax jurisdictions. Pharmaceutical companies that use transfer pricing to allocate profit to low-tax jurisdictions. Investment funds that structure their carried interest through partnerships in the Cayman Islands to achieve favorable tax treatment. Banks that use correspondent relationships and nominee structures that are the direct descendants of the mechanisms Meyer Lansky developed. All of these practices are legal. All of them trace their conceptual DNA to work that was done by a man the federal government spent 50 years trying to put in prison. This is not a comfortable fact. It is a fact that the financial industry does not discuss, and the regulatory community does not like to confront directly. The architecture of global offshore finance was developed primarily to serve criminal purposes. It was refined and scaled and eventually incorporated into the legitimate financial system, not because the legitimate financial system independently invented it, but because the legitimate financial system discovered, in the 1960s and 1970s, as offshore jurisdictions began actively marketing their services to corporate clients, that the structures that had been developed for criminal use were extraordinarily well suited to the perfectly legal but equally motivated desire of corporations and wealthy individuals to minimize their tax liabilities. The offshore system became legitimate not because it was cleansed of its criminal origins, but because the behavior it facilitated, the reduction of tax liability through the strategic placement of assets in favorable jurisdictions, was ruled to be legal. The IRS and other tax authorities have spent decades trying to develop rules that prevent the most aggressive uses of offshore structures. They have had limited success. Because the system is more sophisticated than the rules designed to contain it. Because the people who build and refine the offshore structures are, in the tradition established by Meyer Lansky, smarter and more patient and more creative than the regulators trying to catch them. The $57,000 that the FBI found in Meyer Lansky's bank account when he died represents his understanding of this dynamic. He did not keep money in American accounts because American accounts are visible to American authorities. He kept just enough money in visible form to maintain the appearance of the man living within his means. The rest existed in the system he had built, in forms that were legally inaccessible and practically untraceable. The FBI's 50 years of investigation, their task forces and their informants and their forensic accountants produced a final accounting that was embarrassing not to Meyer Lansky, but to the FBI. They found $57,000. He built $300 million. The difference between those two numbers is the measure of how completely the system worked. Where is the $300 million now? This question is, at this point, probably unanswerable in any specific sense. Money that has been in offshore structures since the 1950s and 1960s has been reinvested and compounded and restructured and passed through multiple generations of nominee arrangements and corporate entities for 7 decades. The specific accounts that Meyer Lansky held are long since closed and replaced with different structures. The money itself has transformed multiple times, from cash to securities to real estate to cash again, through transactions that each leave less of a trail than the one before. What remains is not a traceable pool of $300 million sitting in an identifiable account somewhere. What remains is a distributed architecture of assets that have grown and branched and changed form across 7 decades of investment, in jurisdictions that provide no cooperation to investigators and that operate under legal frameworks specifically designed to make the kind of ultimate beneficial ownership transparency that would be required to trace those assets politically impossible to require. The money is in the system that Meyer Lansky built, the system that became the architecture of global offshore finance, the system that holds $20 to $30 trillion of assets belonging to corporations and wealthy individuals and governments and funds from every country on earth. $300 million, somewhere in that 20 to 30 trillion, invisibly integrated into the fabric of global finance, growing in the dark, exactly where Meyer Lansky put it, and exactly as he designed it to remain. He built the invisible ledger. He filled it. He made it permanent. And then he died at 80 years old in a modest apartment in Miami Beach, with $57,000 in his bank account, and a system that changed the world in his wake. The FBI agent who spent 30 years on his case retired without finding it. The forensic accountants who spent careers trying to reconstruct it gave up without tracing it. The system simply worked, the way Meyer Lansky designed everything to work, completely, permanently, invisibly. If this story about the man who invented modern offshore finance, who built the invisible system that holds trillions of dollars today, who defeated the entire apparatus of the American government with a pencil and a ledger book, moved you, subscribe to this channel, because the full story of Meyer Lansky is still being written in balance sheets and corporate structures and tax filings around the world every single day. Drop a comment. Tell me what you think about a system built for crime that became the foundation of global finance. And remember this: the most powerful thing any person can build is a system that outlasts them. Meyer Lansky built one. It is still running. There is one more dimension to this story that the financial architecture alone does not capture. It is the dimension of timing, of how Meyer Lansky came to build this system precisely when the conditions for building it were available, and of why nobody else built it first. The 1940s and 1950s are a specific and unrepeatable moment in the history of international finance. The world is reorganizing after the Second World War. The Bretton Woods system has established the dollar as the global reserve currency and created the institutional framework of international monetary cooperation. Capital controls, restrictions on the movement of money across borders, exist in most countries as a legacy of wartime financial management. The international banking system is in the process of being rebuilt, and the rules that will govern it are still being written. This moment of institutional flux, of a world where the old rules have broken down and the new rules are not yet fully established, is exactly the moment when a person of Meyer Lansky's intelligence and resources and willingness to operate outside conventional constraints can build something that would be impossible to build once the rules have solidified. He moves into the spaces between the emerging regulatory frameworks, before those frameworks have identified the spaces as needing to be closed. He establishes banking relationships in jurisdictions before those jurisdictions have been subject to international pressure to restrict their secrecy provisions. He builds the architecture of the invisible ledger in the window when the window is open. And by the time the window begins to close, what he has built is already established and functioning and too deeply embedded in the emerging international financial system to be easily removed. This is not luck. This is the specific form of strategic intelligence that characterizes everything Meyer Lansky does. He reads the environment. He identifies the emerging structures before others have seen them. He acts in the space between what exists and what is coming. And by the time what is coming arrives, he is already positioned in the next space, already building the next layer of the architecture that will be impossible to dismantle once it is in place. Meyer Lansky has no such constraints. He is not trying to rebuild something that existed before. He has no professional norms to respect. He has no regulatory framework to comply with. He has only the problem he is trying to solve and the intelligence to think about it without any of the conceptual limitations that would constrain a legitimate financial professional. The urgency of his problem, the IRS, will take everything if you do not find a way to hide it, combined with the freedom from conventional thinking that came from being outside the legitimate system, produced innovations that the legitimate system itself was incapable of generating. The system that Meyer Lansky built is still running. The basic mechanics of placement, layering, and integration are still the mechanics of offshore finance today. Governments have passed laws. Regulators have issued guidance. None of it has eliminated the basic architecture, because the architecture serves purposes that are now considered legitimate by the corporations and individuals and governments that benefit from it. Meyer Lansky built it for criminal purposes. The world adopted it for financial ones. The $57,000 in his bank account when he died was not the measure of his failure. It was the measure of how completely he succeeded. The money was not in his bank account because the money was somewhere vastly more secure than a bank account. It was in the system, in the invisible ledger that nobody could open and nobody could read and nobody could seize, growing and compounding and existing in the permanent safety of absolute invisibility, exactly as designed, exactly as intended, exactly as he built it to be. The Cayman Islands building with 18,000 companies registered at a single address. The Luxembourg holding structures that allow European corporations to pay effective tax rates that are a fraction of the nominal rates. The Irish intellectual property arrangements that shift profit from where products are sold to where licenses are held. The Delaware shell companies that allow anonymous ownership of American real estate. All of it traces back to the same source. All of it is built on the foundation that one man laid in a series of transactions conducted through trusted couriers and discreet bankers in the 1940s and 1950s, when the world was still figuring out what the rules were going to be, and Meyer Lansky was already 3 moves ahead of wherever the rules were going. He did not leave a legacy in any conventional sense. There are no buildings with his name on them, no foundations, no charitable endowments, no public monuments. The only legacy he left is the system, the invisible, permanent, globally distributed, multi-trillion-dollar system that he built from scratch because he had a problem that needed solving and the intelligence to solve it in a way that nobody else had thought of. The most consequential financial innovation of the 20th century, built by a man who could never publicly claim credit for it, used by institutions that would never publicly acknowledge the debt, running still, invisibly, in the architecture of global finance, exactly as he designed it to run. That is the invisible ledger. That is what Meyer Lansky built. And that is why, when you read about corporations paying tax rates that seem impossibly low, when you read about wealthy individuals whose assets are held in jurisdictions that their home country's authorities cannot reach, when you read about the $20 to $30 trillion sitting in offshore structures around the world, You are reading about the legacy of a man who died with $57,000 in his bank account and changed the financial architecture of the world.